Welcome to Wholesale Change, the webcast and podcast from Distribution Strategy Group, where we provide thought leadership for wholesale change agents like you. My name's Ian Heller. I'll be your co-host today, along with my glamorous business partner, the Doctor of Distribution, Jonathan Bein, PhD. How you doing this morning, Jonathan?
Well, Ian, how are you? Thanks for the superlatives.
Well, today you're just a Doctor of Distribution. You know, I forgot to think of something special. So
well, you added in glamour, which is a new one. But
that's true. Glamorous is that's usually something around, quantitative genius or, the Emperor of Excel. Today it was glamorous. So
yeah, well, I mean that is kind of glamorous in this new world that we live in. So
yeah, well, and for those of you who are on the webcast versus the podcast, Jonathan and I are both wearing plaid today, so it's a plaid day out here in Colorado. And given the snow and cold, that seems appropriate, doesn't it?
Yeah, don't get plaid, get even.
That was hilarious. Anyway, so today we're going to talk about the quarterly results for 4 different distribution companies. We'll make some comments, and then we have a topic to haggle over, argue about, as is our want. But the companies we're going to talk about today are Grainger, Fastenal, MSC, and a little bit about Motion Industries. Motion's embedded inside a much bigger company called Genuine Parts, so there's not as much data about them, but there's enough in there for us to make some observations. So let's jump in. You ready, Jonathan? You ready to do this?
Let's go, man.
All right, good. So Grainger, these are some highlights. So their third quarter sales were $3 billion, apparently on the nose or close to it, which is 2.4% over third quarter of 2019. So I mean, it looks like they're recovering, right? Wouldn't you say?
For sure. Yes. I mean, they had a dip along with many other companies, and have managed through it pretty well.
Yeah, their operating margins were up 1.1%. Gross margins were down a lot. That's 170 basis points I'm seeing there, from 37.3 to 35.6. Mm-hmm. So that pushed their stock down a little bit. It was like 5.6% down in a week, but it's still up 13.3% in a year and 27% in 6 months. So they gave some back. But clearly analysts did have a pretty negative reaction to this margin degradation. What's your view on that, Jonathan?
I guess it's all relative. They're still trading at a healthy total market cap of around 18 billion.
19.
Is it 19? Okay.
Yeah.
I said around.
Sorry.
Okay. So they're trading at 19 billion. So apparently that effect has not been that large, given that they're still trading at that high a market cap.
So I guess my views have kind of run counter to analysts over the years with Grainger's margin, in that I think them bringing down their margins is a healthy thing. And I felt that when DG McPherson originally came in and he used his honeymoon period to do something really gutsy, which was to slash prices pretty aggressively. He took a lot of heat for that, but he was smart in 2 ways. One was that was the only time he could really do that, I think, was in that first year of his first year in office. And then the second thing is that Grainger just got overpriced. I mean, one of the things that bothers me about distributors and distributor analysts is there's this sense that the higher the margin, the better, no matter what. And that is just absolutely not my view at all. And Mark just wrote in, it's largely due to PPE though, right? The margin degradation. And yes, I think that they specifically say that in their earnings release, that this is because of the growth of PPE, personal protective equipment. And I get that. But even with that, I don't think it's bad for their margins to come down some. I mean, you've got to be competitive. This notion that you can just continue to increase margins forever in a distribution company, that is one philosophy of profitability. Meanwhile, Jeff Bezos over at Amazon is saying our profitability is not our customer's problem. We're going to be competitive first, and we'll figure out how to make money later. And that sort of putting the customer first view. And I understand, look, you screw that up and you're going to go out of business because you're running out of money. Can't do that either, right? So you want to definitely claim your value. That's different than saying margins should go up forever, which is frankly sort of the attitude that I see a lot of distribution executives have. Do you run into this, Jonathan? Am I off base here?
Well, at some point, elasticity kicks in, right? Elasticity is not the same at all points along the curve. If you have a demand curve, it's not elastic, similarly elastic at all points along the curve. So at some point, you're going to hit a part of the
Right.
curve where it becomes very elastic. But I think also to your points that you brought up previously, in the importance of, if you are going to get margin increases, can you do it on the supplier side as opposed to the customer side, right?
Yeah, I mean, every time you talk to, well, that's no, I don't want to make an extreme statement. Most of the time, when you talk to distributors about increasing profitability, they hear that as synonymous with raising prices to customers, and then you start asking them, well, how many people in your organization can buy and cut POs? And it's like dozens or hundreds, and all these people buying inefficiently, spot buying. They don't even know how much they're buying from every supplier because they've got some generic SKU that they put all this source stuff under. And so you've got all kinds of suppliers that you're buying a lot of money from. You don't know it, you're not centralizing it. There's no rebate or pricing negotiations. Why not clean that stuff up first before trying to ask for more money out of customers, or at least do it simultaneously?
Absolutely. And I think back to Mark's point, this comment about the PPE, it's also PPE and Jansen. We're going to see a
Right.
trend here. Maybe some of our listeners on the show and viewers on the show today who have operating roles are experiencing the same thing. You're selling more PPE, you're selling more Jansen. Historically, those used to be higher and better margins, but certainly with the PPE, there's been almost a glut of supply, and that's pushed the prices down on PPE. So that product mix is definitely affecting Grainger, and it's not just PPE; it's also Jansen.
Yeah, right. And sales were pretty strong. I mean, they said U.S. segment sales were up 3.1%, versus the overall U.S. MRO market declining at 5 to 6%. So that's like an 8 or 9% outgrowth versus competitors. And this was driven largely by higher volume of pandemic-related products, partially offset by year-over-year decreases in non-pandemic product sales. So there was a product mix change that changed margin, and they took share, but the stock price fell because investors were expecting even better performance. Apparently, although they beat earnings and sales, or they I think they met one and beat the other. So I think the stock price retraction was due to the gross margin performance. I think that's ridiculous. I mean, it's obviously a temporary thing. It's driven by product mix. What are they supposed to do? Not sell the PPE during the pandemic? And so I think it's a buying opportunity for Grainger. I mean, like, I'm qualified to get stock advice, but don't listen to me. I'll tell you right now, don't listen to me on stock advice. But I do think that's an overreaction. That's a pretty big decline based on a 1 quarter gross margin decrease that's easily explained and probably healthy in the long run anyway. That's my point of view.
So let's talk about Grainger and Zorro in their mix.
Okay.
So in their report, they've talked about Grainger is focusing on wallet share,
Mm-hmm.
and Zorro is focusing more on market share. And they describe their addressable U.S. market, by the way. That's the part
Right.
that they can reach with products, brands, channels. They describe that as about $120 billion addressable market share.
Right.
What's your understanding of Zorro's role in the strategy going forward?
I think it's high tech, low effort versus high touch. So I noticed in their earnings call, they said that over 60% of our U.S. revenue is generated from customers with one or more embedded solution. So
That's extraordinary.
yeah, it is extraordinary. It's like keep stock, right? And 75% of the sales, they said in August, are coming in through electronic channels. Of course, they include EDI in that at Grainger. Not everybody does, but it's kind of a compelling combination. It's very, very easy to criticize Grainger because of the growth of Amazon business. And I think on the earnings calls over the years, and in their public statements, they've made efforts to differentiate or claim differentiation with Amazon business. But a couple thoughts. First of all, if you've got 60% of your sales coming from embedded solutions, you've got some high barriers to exit the relationship for almost 2/3 of your sales. The second thing is, and I absolutely love this, I don't remember his name, but on LinkedIn, I follow somebody and he's like a manager for KeepStock operations somewhere at Grainger. And he keeps posting pictures of Grainger vending machines in Amazon distribution centers. So
There's a little irony.
yeah, but he does it. He's not doing it to slam Amazon. At least if he does, he's not explicit about it and it doesn't come across that way. But, his point, I think, or the point maybe is that even Amazon sees a need for Grainger's type of MRO capabilities. And the first time I saw it, I was really surprised. It really caught me off guard to see all these, keep stock vending machines in an Amazon distribution center, but it really makes the point that they have a differentiated value proposition. Zoro, they said that they've added 1.5 million SKUs this year, pushing its assortment to roughly 5 million products. And I know Zoro's working on a third-party marketplace. All I would say, and I don't know why it's not going faster. At least my impression is that that's not growing very fast. They just have a, sort of a generic landing page for it. And I don't know if they're trying to get the capabilities ready in IT or if there's a debate about it at Grainger. I have no idea, but I would say they need to move faster because they need a true third-party marketplace. As good and impressive as 5 million SKUs is, it doesn't compare to true marketplaces.
Point taken. Another part of what they are looking towards in the future is really improving the customer experience from a digital standpoint.
Yeah, right.
And they're talking about making the on-site search better, improving product data. So I think this is a note to listeners of, we need to look at where Grainger is going with digital, because most of the rest of us are following rather than leading Grainger in that. So they're improving on-site search and visualization capabilities. In fact, they've credited marketing with contributing to their U.S. market share gain over the last 4 years. And that's both on the advertising side, but also in paid search. So that's where Grainger's doubling down.
Yeah, and they have, they've got they may not be the only distributor that has item recognition on their app, but they're certainly one of the only ones. So you can open the Grainger app and point it at a product and it'll match it up. Now I don't know how well it works, but we're used to seeing item recognition coming from the big players, the big tech-based players, plus some big retailers like Home Depot have it. But it's impressive to see Grainger put that in place. I think to some degree it only works as well as the number of products that you have that you can match to. So they need to continue to double down on expanding the assortment. But overall, I thought it was a pretty impressive report from Grainger.
Yeah, I would think that the match rate on the item recognition to be workable for somebody is going to have to be above 85 or 90%. It doesn't have to be 99%.
Yeah.
But I think if you're above the 85% match rate, people will use it, and with the understanding that 1 out of 5 or 1 out of 6 or 1 out of 7 times it's not going to match.
Yeah, that's probably fair. Now, they did say the endless assortment model, which includes Zorro and I think it's pronounced Monada Row, continues to deliver with 20% growth in the third quarter. So that's impressive, right? My only caution there is my guess is there is some cannibalization there with some of that revenue coming out of the historical or the traditional platform. Okay, I think that's it. Anything else you want to say about Grainger before we move on?
No, I think that's good.
Okay, great. All right, so let's talk next about, I think we've got MSC teed up next, and we do. Okay, so MSC did a little over $750 million in the third quarter. They did 748 million. That was down 11% over 2019. So substantially down versus Grainger's performance. Operating margins were down 0.3%. Gross margins were essentially flat, down a little bit. What was your first takeaway when you saw these numbers, Jonathan?
I think their end markets are going to be a little weaker than at least part of what Grainger's selling into.
I agree.
So I think that's a really big piece. But they, like Grainger, have seen the product mix bring margins down, the PPE and Jansan. So I think those are two of the big contributing factors.
So what really stands out for me about MSC is that, here you have a So $3 billion company roughly, right?
Yep.
3 billion-ish, probably a little bigger. And their market cap is 3.8 billion.
Right.
Grainger's is 19 billion and Fastenal's is 20 something billion.
25.
25, right. So you've got, I mean, the PE or the PE ratio on these companies is wildly different.
Yep.
And the other interesting factor is MSC says that 60% of their orders come through electronic channels versus Grainger's 75%, even though MSC is more of a distribution center based business. So I don't, something doesn't add up here, and I'm not sure what it is.
Well, if you think about their end customers, at least a big part of their customer base, which is machine shops, it can't be the case that those machine shops are doing punch out and EDI, right?
Mm-hmm. That's true.
So I'm sorry, yeah. So um, so I think a lot of that from those smaller end customers is going to be coming through the website. But then as you look towards the larger customers, you're going to be seeing that coming from the EDI and punch out and e-procurement.
And a lot of phone
Um,
calls, apparently.
and a lot of phone calls, right? Because it's hard to see how, given the nature of their mix, they get a 60% number going through e-commerce. That just doesn't make sense.
You think it'd be higher, you mean, or
I would think it would be lower.
you do? Okay.
We've done work in the gas and welding space,
Yeah.
which has got some overlap with this, and the end customers in that space are just not very digital oriented. So that's why it's hard to understand how you get to that 60% number. I think a lot of it's got to be coming from larger customers that have e-procurement, enterprise accounts.
Yeah, I think the other variable here is that MSC has more complex products on average than Grainger. MSC is a lot of machine tool accessories, cutting tools, et cetera. And it's more likely that customers are going to need some help walking through those choices. And so they're going to be more likely to make phone calls. And I got to tell you, you know how I feel. I think this whole notion of what percentage of my business is coming through digital channels can really go too far. If you focus on that too much, you can wind up forcing customers to place orders in ways that they don't want to, which means forcing them to go to competitors. And so you want to have fantastic digital capability. You should have a healthy chunk coming through your digital channels. But if that becomes your goal, that's not a customer focused goal. That's an analyst focused goal. You're trying to please analysts, and you can overdo it. And it might well be that having stellar phone service is still highly valuable. And I think it is.
Well, even if the shopping is done digitally, the order is placed by phone, right?
Right.
So the website is getting a significant assist in the total credit of the sale. It's the order is just not being placed through a digital channel.
Yeah, fair enough. True. Okay. And so they announced their mission critical, or not. I don't know if they announced it. They no, they
They
said for the
emphasized it.
past several years
Yeah.
they've been repositioning the company from a spot buy supplier to a mission critical partner on the plant floor. So tell us what that means, Jonathan.
Well, I think we've spoken about this in previous episodes about the fact that a lot of distributors have services or value-added services that touch procurement or inbound logistics, and that's great. And that's where you're getting, all the VMI, perhaps vending, those sort of integrated supply. But I think to the extent that they are affecting the core operation of the business, that's a very, very strong move, and will make them very sticky with their customers. They talk about the shop floor, or the plant floor. That's where they want to be.
Right.
So I think that is a stronger move. I think there's fewer distributors that are creating value in the core operation of the business, and there are more that are doing it on the inbound logistics and procurement side of things.
Right. I agree. I think and we know distributors, a couple of whom are on this call, who are making a great effort to develop and implement services, and they're hiring someone to head up their services and manage it like a P&L. Kudos to those distributors. That's exactly the right thing to do, in our opinion. And MSC is doing the same thing, right? And they're going, look, we don't just want to be important to the receiving dock. We want to be important on the shop floor where the action is, where where the true value is added, where the company is taking inbound materials and transforming it into something of value, of greater value, and earning its margin. Because if we're helping that company earn its value added, earn its margin, then we become more essential to the company and it's harder for them to exit. So I think the real issue is just execution risk. I mean, did they choose the right initiative? Sure. But now you have to execute well. And they say that they've got some priorities: build on a talented team of metalworking specialists, leverage exclusive MSC Millmax technology, increase investments in vending VMI and in plant solutions programs, elevate websites and other digital tools, and scale presence in countercyclical businesses. I'm reading this from an article that was in Industrial Distribution that came out, I think, earlier this week or a couple of days ago. That's very, very good. It's very well done. I think Mike Hockett wrote it, but I would definitely read this article. And then on the sales and services supply chain side, they want to optimize their DC network. It sounds like, some consolidation perhaps, or some expansion, renegotiate supplier contracts, redesign talent acquisition search, reduce long-term freight contracts, and voluntary early retirement program, probably to manage some costs, given what's going on with the economy. I mean, if they execute that well, and they also want to diversify customers and end markets. So that's a lot of stuff they're focusing on, but it's all focused around a single type of, or a couple of initiatives. What do you think of that list?
I think MSC is known as being strategically thoughtful business, and I think these components of their go forward plan are reflective of that strategic thoughtfulness.
Right. And the question becomes, can they execute it well? Right.
That's right.
Okay. So no surprises here. I mean, it feels to me that MSC has an opportunity to build a lot of market cap.
Mhm.
They just, on a PE basis, they just seem undervalued, and that may not undervalue compared to their peers. That doesn't mean that they haven't earned this valuation, because analysts are very thoughtful. And I've met with a lot of analysts in my career. They have piercing insights into these companies, so they're not making lighthearted decisions about what to value them at. Um, I just think there's an opportunity for MSC if these are the right initiatives and they execute them well, which is tough for any company. I'm not singling them out. There's some upside here.
Yeah, I mean, I think we have to look at the profitability of MSC versus Grainger. So the percentage profitability of MSC is actually higher than the percentage profitability of Grainger.
Right.
Yet Grainger's got a higher PE. By contrast, and we're going to look at Fastenal next. Fastenal is quite a bit more profitable than any of the four companies that we're looking at, and it seems like they are rewarded in their PE and in their price. So,
Right.
yep.
All right. So speaking of Fast, which is their ticker symbol, let's look at Fastenal. So the third quarter sales were 1.4 billion, up 2.5% versus 2019. Operating margins were up 1.1%. Gross margins were down 90 basis points. And so all things considered, given the product mix, as we've talked about earlier, that seems like pretty decent performance. And their market cap is a hair over $25 billion. Any comments on that before I start talking about their commentary?
Well, it's just an astounding market cap.
Yeah.
I mean, you just don't. A lot of distributors are valued at a third to 40% of top line revenue, or a much lower PE. And
Right.
so they are awarded. Part of it is that they have been very consistent in their growth. So if we look at sort of a pattern of companies that have gotten more profitable during the downturn, the pattern looks like perhaps they meet their top line goals or not, but they definitely reduce SG&A, and some of them are actually showing higher profitability. Fastenal actually is meeting their top line goals, and even with some decrease in the gross margin, they're beating their earnings estimates, and they're beating their profitability estimates. So they are just a formidable player who is just is it the Energizer? They just keep on running. They just keep
Energizer,
growing.
Energizer bunny.
Energizer Bunny, every quarter, it's all things are up and to the right, even in the downturn
Yeah.
for
You,
Fastenal.
I tell you, you read this earnings transcript and it's not like any other in distribution. I mean, it reminds me of when Herb Kelleher was out Southwest Airlines, and
Mhm.
there's a bit of irreverence, but this obsession not only with customers but with employees. And so Dan Florness, who's the CEO there, these are his opening comments, and I'm picking from a few paragraphs. One of the jovial aspects of my role here at Fastenal is in the fall of each year, I send a letter to all of our 25-year employees. Bill Drzazkowski, he's our leader in the Western United States. In August, he celebrated 25 years. I remember the first time I met Bill. I was traveling in southern Minnesota. He was working at our Albert Lea, Minnesota branch. My first impression of meeting Bill was I didn't realize we hired 16-year-olds. Because I guess he looked young. But so he has this whole thing about all these 25-year employees. He names a bunch of them by name, and then he closes the call. So the very last thing he says on the call is let's see here. Oh yeah, here it is. And in closing, on October 28th, my wife and I will celebrate 25 years. And Jen, thanks if you're listening. Have a good day, everybody. Take care. So he opens up with, celebrating his 25-year employees, and he ends with a call out to his wife, to whom he's been married for 25 years. So he bookended that nicely, maybe coincidentally, but very nicely. And then the whole call is just so different. It's all about this customer obsession, about, field employees taking them to task for added costs, because they're all running their own P&L. They don't like seeing headquarters costs go up. So he's explaining how they've, invested in all these mobility products. I mean, it sounds like they haven't laid anybody off. They have a little, I think 1% of the people still furloughed, if I'm thinking of the right company here. And they have a detailed report on their COVID statistics. And he's pretty unapologetic. He had at one point talked about how someone had pointed out to him, so Holden, I think is their CFO, gave me a couple of analyst reports that came out earlier this morning. And there I saw where we have, this is funny, he apparently didn't know this already. There I saw we have $30 million of slow moving PPE inventory. I mean, which CEO is going to admit that he learned something from an analyst report that he didn't know? I mean, it's just a refreshing.
It's
humility.
it's an ROC, return on culture. And so a
Yeah.
lot of companies will brag about their culture, and a lot of times it's kind of hokey.
This is real.
This is real, and
Yeah.
and they're living it, right?
And he says, I think there are folks in our organization that are looking at our PPE inventory and saying, geez, we have a bunch, and they're scared about it. Nervous about it is probably a better word. But based on our sales in Q3, we do have months of supplies. Frankly, in today's chaotic world, I consider that an asset, not a problem. And it will support us as we move through this, and I'm happy we have it. So if you need a 3-ply mask, give us a call.
Right.
So, I mean, they're always selling, right? They have the sales focused culture. And, so the comment, then I'll shut up in a minute and let you talk, Jonathan, but I just want to, on the slide, for those of you on the podcast, we have a statement out of their earnings call that says, we protected our talent the way we did through what certainly initially looked like a pretty nasty downturn, specifically so that we'd be able to move quickly when conditions allowed. And with demand getting gradually better, and with our customers increasingly re-engaging in conversations about growth drivers, in many respects, that moment has come. So you think about, okay, as a distributor, you provide inventory and you provide service, which comes through people. Here's a company that managed to negotiate their way through the Great Recession. I'm sure there's some luck involved based on end markets, et cetera, but they managed to really protect their revenues through the recession. And look what happens now. They've got the inventory, they've got the people where they could potentially rebound significantly coming out. At least that's my view based on reading tea leaves.
Well, and here's where the V-shaped rebound for them has actually manifested. They look, as everybody knows, at what they're doing with vending machines, and they look on a business day basis, and they were at 75 a day new vending machine installs in Q1. They dropped to 54 during Q2, and then they're
Right.
up to 73 again in Q3.
Right.
So that's evidence that they have experienced that V-shaped recovery. And so they're signing up, do the math, they're signing up 25,000 new vending machines every year. And all of that just gets stickier and stickier and stickier in their end customer base.
Yeah, they're apparently making progress with governmental entities. Um, and we do have someone who's asking about their private label sales. And I don't know, I don't remember seeing that referred to in their materials, Jonathan. Did I miss that? Did you see that?
I didn't see that either.
Yeah.
I'm curious, Scott, if you have anything to share on that, or even what's behind the question.
Um, yeah. So I don't see, I mean, look, this company's got their act together. I think the big question about Fastenal to me is how long, and maybe the answer is forever. How long does this local model of large stocks of fasteners um, really serve the market? And fasteners are very, very hard to sell online, and people have tried different approaches. And I know they're much more than fasteners, but it is in their name, right? Um, but they've tried various approaches to selling fasteners where I remember there was one app, I don't even know if it's around anymore, but you could, put a fastener, like a screw down, and you put a coin next to it of some kind. And then the software would identify the specifications of the fastener. And I don't think that ever worked, right? It's just really hard because it's not just the thread count and the shape of the fastener, it's also the material that it's made of that is an important part of its specifications. And I just think it's a problem to sell a lot of the stuff that Fastenal sells any other way than through a local counter. And I also think there's an advantage if you're in the fastener business in that you can store an enormous amount of assortment and some pretty good depth for relatively low cost per location, which is why and those stores can be small. So they have like thousands of small stores, and they still seem to be yielding value. And at the same time, they're matching it with good e-commerce performance and on-site performance and a great culture. So, I mean, they're not, they make mistakes like any other company does. I'm not calling them perfect. And maybe all that stuff was already priced into their shares. I don't really know. But it was impressive to read and fun to read their earnings call compared to a lot of other earnings calls.
Yeah, I think to your point, they have been a little slower to adopt digital. I know their sort of ramp in digital was starting a few years ago as opposed to 10 or 15 years ago. If you look at Grainger, it dates back to the time when you were there, right? MSC has been on this path strongly for about 10 years. So I think to your point, it is a slightly different business model that lends itself less to the digital side of things. But the other opportunity for Fastenal is if you think about the fastener sector, quick, name three fasteners suppliers, big name suppliers. You're hard
Uh,
pressed to do that, right? In other sectors, you have
I could do it. I could do it.
significant.
I could do it.
You could do it.
Yeah.
Okay, okay.
Go ahead.
So give me two.
Fasteners Inc. and Fastenal.
Okay, but no, Fastenal is. I'm talking about manufacturers.
Oh, manufacturers. I'm sorry. Yes.
Right. So it's
Yeah.
not like electrical
I'd
where
have
you've
to
got.
work at it. Right.
You have to work at it, right? It's not like electrical where you've got Eaton
Well,
and
the brand doesn't matter. The
the
brand
brand
doesn't
doesn't
matter.
matter. But I
Right.
think that's a place. It's actually an opportunity for Fastenal to add value. And I think to Scott's point, what he mentioned was that this is one of our listeners today, that they've historically been approaching 50% of their revenue through private label,
Yeah.
right? And so, companies that execute private label well can see very high margins, right?
Well, and protect their revenues because you can't cross shop very
That's
easily.
right. Yep.
Um, so, and by the way, I don't know, this is probably dumb. By definition, I'm saying it, so it's probably dumb. But I
Oh,
was reading,
stop.
Grainger was talking about their vibrant employee culture, which is great. I'm not criticizing that. But then after that, I was reading the Fastenal notes and I thought, well, they've got a Vibram employee culture. It's all about boots on job sites and in factories, and so it's great to be vibrant. I think that's a good thing. I'm not making fun of Grainger, but I came from Whitecap and we had a Vibram culture as well, where it was all about wearing boots and being on the job with customers. I mean, there's something interesting when you go out to a job site and you can barely tell the employees in your company from the customers. When the employees and the customers look the same, it's almost like there's this melding of intent and aspiration and culture and values.
Mhm.
And I see that. I'm not familiar enough with Fastenal to know for sure whether or not they have that, but it seems like they do. And we had it at Whitecap. It was funny. Whitecap had a big presence at the World of Concrete, and several years ago, just because I was curious, I started walking through our competitors' uh, displays, and I walked to the Fastenal display, and man, it was so funny because we were sort of indirect competitor to Fastenal, not from my perspective, not significant, but man, they were like, "Don't you touch anything, buddy. We see you. We got our eyes on you." It was funny because it was like they're very proud of their brand, and they viewed me as an interloper because I was all geared up in Whitecap stuff, and I like that. I was smiling at these guys. I'm like, man, you guys are like me 20 years ago. Sort of. This is our team. We're gonna defend against all interlopers. It made me smile, and I think that Vibram culture brings that out, where it's a will to win, and
Mm-hmm.
and it's hard to build that. Whitecap has it, Fastenal has it, and there are other kinds of cultures that are very, very successful. I'm not saying you can't do it in other ways, but I do like, personally, I fit better in a Vibram culture than a vibrant culture.
Mm-hmm. Very nice.
So, all right, shall we move on?
Let's move on.
Okay, so last one we're going to talk about. We're going to do this briefly, and then I'm going to ask, and we're going to argue. But um, so Motion Industries is embedded within GPC, Genuine Parts Company, and they said their industrial sales were $1.4 billion in the quarter, an 18.6% decrease from a year ago. However, excluding the EIS divestiture, because they sold EIS off, industrial sales were down approximately 9%, which is a significant improvement from the second quarter. And so I think, you know, based on what they do, right? They sell a lot of power transmission products, and they sell to factory floors. Uh, they probably perform just fine. They didn't have information in there about how they performed versus their peers, so it was really hard to tell. Our segment profit of 126 million was down 8%. So they got a little leverage and cost savings. And the profit margin was up 80 basis points to 8.9%. So they look like another industrial distributor doing a decent job managing through the crisis. Not stellar, not bad. The most interesting thing about this comparison, or where GPC fits in, is they have a market cap of 13.5 billion, even though they're a much larger company than Fastenal, which has a market cap of 25 billion. And so that's based on, investor confidence in future results, basically, is a lot higher for Fastenal. But, that's Fastenal outperforms everybody. So that's not a shot at GPC. But, we just don't have as much insight into Motion. Do you have any comments before we move on, Jonathan?
Well, I think again, this fits into that pattern of our revenues down, um, our margins are down, but our profitability is up. So one of the things you hear from CEOs, private and public, is, yeah, during the downturn, we let go of some people we probably should have let go of anyhow. I mean, I've heard that from any number of profit and loss holders. So this pattern of revenue down but profit up is based on cost cutting, but there are other sort of perks of COVID, if you will. Or one is just simple things like you're not paying as much to sales reps for T&E, right? Because they're not going to customer sites as much. So there's
Sure.
all kinds of things that happen in sort of SG&A engineering in COVID that allow companies to have lower revenue and higher profit. The question is whether they're gaining true efficiencies in the process, right? Are you just cutting people, or are you actually getting more efficient with a smaller number of people? I mean, so as opposed to, are you just working a smaller number of people a longer number of hours?
Yeah, I think that, just generally speaking, whenever you go through a crisis, it gets a lot easier to make hard decisions because you don't have any choice, right? And that's the human condition. None of us likes, as managers, everyone loves to hire, nobody loves to fire. And if you do love to fire, you shouldn't be a manager, because it's not a place for sadists. Um, Having said that, I think that, generally speaking, corporations have a bad tendency to hire people they don't really need. And I've been guilty of that myself. I think it's important that you constantly add up all the open approved positions and figure out if you hired them all tomorrow and you suddenly had that payroll, what would happen to your P&L? Because positions get approved one at a time. And pretty soon you've got 30 or 300 open jobs that people are actively recruiting for. And if you suddenly filled them all, what would happen to your P&L? And I've seen people do that analysis. It's pretty devastating. I mean, you actually have some risk out there that you're not identifying that's in your open positions, because that would bring on an incredible amount of cost burden to the organization. And so they all got to prove to the legitimate process. Everybody thinks they need these positions, but most companies are not summing up all those open positions, open recs, and figuring out what the impact would be if they hired everyone. And so I think it's something that gets done on a case by case basis, but it has an aggregate impact that's underestimated in many companies. And a crisis like this, and I know it's a cliche, but never waste a good crisis. I think this is an opportunity to right size.
So here's an important question for you. You're saying if I'm a sadist, I shouldn't be a manager, but could I be an individual contributor?
Oh, of course.
Okay, good.
Yeah, because you need someone to do a statistical analysis.
Statistical, very nice. Okay, very nice.
And with that, everybody hangs up from this call.
That's right. So so before we move into the point counterpoint part of this discussion, I wanted to mention to our viewers and listeners, we're going to be tracking public distributors in a more systematic and thoughtful way, and we'll be producing a part on our site that has essentially an index of probably a couple of hundred of public distributors in the U.S. So just a note to self, start looking for more information on this, and we'll be tracking in a more systematic way.
Cool. Looking forward to that. Thanks for leading up that effort. Okay, so I don't have the question on the stream, but I do have our valuable contact information in case any of you wants to call or write us or send us hate mail based on my bad jokes. But here's the question, Jonathan. If you were the CEO of a distribution company, would you bring everybody back into the office and branches now?
As a consultant, my immediate out on the question is it depends.
Well, there's this 2x2 matrix.
Yeah, that's right. And it depends in part on where I am in this country. We're sitting in Colorado now. We're seeing COVID like we haven't seen in the entire time. This is like 2 or 3 times the highest peak that we had. So I think it depends on where I am. In any event, we would be using significant caution to bring certain employees back into the office, but in certain locales, it would be caution squared in terms of how we're handling things. How about you, Ian?
I would bring everybody back in most circumstances.
Because why?
Well, first of all, and this is anecdotal information, so I probably do some more analysis first, but from talking to some CEOs, including some CEOs of multi-billion-dollar distribution companies and some others who have brought everybody back, or just about everybody. No one's got a black and white rule where you have to come back no matter what. Everybody makes accommodations for people who are at high risk, or they live with someone who's high risk. So look, you can't be a jerk about it. You need to be flexible to some degree. And if people are really uncomfortable, I would accommodate them for a long time. Let me say that. But generally speaking, I would bring everybody back. And the reason is that statistically, based on what I've seen, people are no more at risk at work than they are anywhere else, assuming they wear a mask. I have zero interest in debating masks. I mean, we've known that viruses are spread through airborne particles for hundreds of years. And if you don't want to wear a mask, then why don't you tell that to your doctor next time you have surgery, right? I mean, I've no interest in debating it. I would make mask usage 100% mandatory. I would test everybody's temperature as they came in, but I would bring everybody back. And the reason is our customers are back. I don't see how it's right or fair or how we can provide great service to customers if we're not where we should be. Now, is it true that your accounts receivable people can work from home better than your customer service people can? Yes, that's fine. Again, I wouldn't make it a black and white scenario. But if you're in customer service or you're in sales or you work the counter, or you work the warehouse or you're a delivery driver, a lot of those people have already been back. They never left, right? They've had to work. And meanwhile, the people with the cushiest jobs, sorry, I guess that's an old field employee point of view, have been safe working from home. Well, I think everybody's safe or just as safe at work as they are from home if everybody wears a mask. Wear a mask, protect yourself, protect others, and everybody comes back to work. This whole economy wouldn't have had to go through this shutdown if everybody wore a mask. Why this is a political thing, I don't get. Just wear a freaking mask and let's go back to work. And that's my point of view. And you know I'm an iconoclast when it comes to things like politics. I'm not trying to make a political statement. Wearing a mask shouldn't be a political statement. It's a scientific statement. And that's my point of view. And I bring people, wear a mask, come back to work. Let's help customers. Let's get back to work. That's my point of view.
Okay, so you're saying particularly for the customer facing side of things, there's no substitute for having people on the job.
Yeah, look, I mean, customer service operations, you have to put the resources where the demand is. When I was running branches at Grainger a million years ago, we had walkie talkies and we would constantly move labor from picking will calls to helping customers at the counter to pick, packing, and shipping in the shipping department. And we used the radios to do it, right? And everybody had one. We charge them up every night. And we were, I used to say communication is lubrication that runs the branch machine. That was like a mantra that I had. And I remember it all these years later. And the same is true of a distribution center. The same is true of a call center. You got to communicate. You should be obsessive about customers, obsessive about customer wait time. I don't see how you execute that well when everybody's working from home. And I don't believe that you can have everybody. I don't think it's fair for the customer service people to be working from home and nobody else is.
Well, as Olson Johnson in Blazing Saddles said to Gabby Johnson, now who can argue with that?
Oh, somebody will for sure. Somebody will for sure. And I get it. But I mean, you know how I feel where every business, including distributors, loses sight of what really matters in your company is the experience that the customers get when they interact with you. That's what defines your brand. It's not your advertising campaign. It's not your SEO. It's what happens when they contact you. And most distributors don't measure that. They don't study it. They're not a customer of themselves, right? I mean, if you're on this call, when's the last time you bought from your own company anonymously? Not gave an order for someone at the office to fulfill for you. When's the last time you went onto your website and placed an order? When's the last time you walked into one of your branches unannounced, stood at the counter, observed, and placed an order? When's the last time you picked up the phone, called your company, and figured out what it was like to buy? I think in many cases that service has deteriorated, but distributors don't know because they're not engaged. And that was already a problem pre-COVID. Now it's a bigger problem now. Put masks on, come back to work, take care of the customer. I don't think you're at more risk than staying at home. I think I've made my point. Now I will shut up and let you speak again. Sorry.
Like I said, now who can argue with that? I hear what you're saying. I don't mean to be facetious. I hear what you're saying. And we do have to get back to work. And as one of our favorite listeners says, Amen Rev.
Amen.
So,
Amen.
yes,
Amen.
yes.
Well, thank you, Joe. I appreciate it. But this is just it's a core value to me, and we can't shut down the economy anymore. And let's get people back to work. But let's do it. Let's not be dumb about it out of some political point of view. It's not a collective plot that happened to enroll leaders from all of our strategic rivals and all of our allies simultaneously to wear masks. It's just a fact. Wear a freaking mask, come back to work. And let's take care of customers, and let's focus on the business objectives and quit arguing with each other about science that's been settled for hundreds of years.
Terrific. What do we have to look forward to here, Ian?
So for the audience, Jonathan just texted me, enough, Ian. Fair enough, Jonathan. I get worked up. So sorry if I overdid it. So anyway, so what did you ask me? What are we looking forward to next?
Yeah.
So we have John Tissera, who's the CEO of Johnstone Supply, coming on the show soon, and he's going to talk about. So this is an interesting question. Can you build a culture virtually? And so John strongly feels the answer is yes, and I do too, right? And I think you're going to be a lot more virtual from now on, no matter what, because it just makes more sense for some people to have that flexibility, at least sometimes. And John feels strongly that you can build a culture virtually, and he's got some very interesting points of view. And so we're looking forward to hearing from him and getting his explanation on that. And then what else is coming up, Jonathan?
We've also got a session coming up soon on building customer incentive and loyalty programs.
Yes, right. So Lincoln Smith from HMI is going to come on and talk
Mhm.
about how you build loyalty programs with customers. I think that'll be very interesting as well.
And about NAW, our next webcast with NAW is on November 17th at 2 Eastern, 11 Pacific. It'll be the fifth in the series of seven on how technology will transform wholesale distribution.
Yeah, and this one is on marketplaces and becoming a digital distributor. So you don't want to miss that. I think we have some interesting insights, and we're pulling together some of the research that we've already done. And then, of course, Wholesale Change will be back next week at this time. So 12 Eastern and 9 a.m. Pacific. Anything else, Jonathan? Or are we done?
We're done.
All right. Everyone, thanks for attending. Thank you for listening to my rant. And Jonathan, thanks for tamping me down a little bit. I appreciate it. I need a little regulation sometimes instead of all this caffeine. Hope you have a wonderful week between now and then. And good business, good sales, and take care of your customers. Bye now.